You asked for it, and today we are here to break it down to the simplest form. The wealth preservation strategy of the ultra wealthy. Now, you can call it the buy, borrow, die strategy. How do you borrow against your assets and remain wealthy? Now, you've asked for it over some time, and we are here to explain that concept to you in a way you understand it better. My name is Providence, and welcome to Clockwise. My guest is here and is always here. He sleeps on the charts. He understands the fundamentals of businesses. He also understands this strategy perfectly. Now, with a resounding virtual round of applause, welcome, Mr. Kane. Welcome to Clockwise.
Thank you very much. Thank you very much.
It's nice having you again.
Yeah.
I think this concept we're discussing today, a lot of people have asked for it. They've asked about it. And you keep saying this every time. On every show, almost on every show, you talk about the buy, borrow, die strategy. And I have a lot of questions here. So many questions to ask you because people say, what is the concept? What is the concept? So this video is to explain it. First, before we dive into those questions, I want you to break it down to the simplest of form to a novice to understand you very well. What is the buy, borrow, die strategy?
Okay, so thank you for having me. So the buy, borrow, die strategy, we call it the wealth preservation playbook.
Okay.
For the ultra wealthy, but I don't think it just applies to the ultra wealthy. I'm not an ultra wealthy person, but I do. This is like my guiding. I swear by it, actually.
Okay.
So this is a strategy that allows you, that takes advantage of some things. Number one, capital appreciation of the stock market. Number two, borrowing cost and borrowing in interest rate environment.
Okay.
Number three, tax laws. Number four, estate planning. These four things actually decide whether or not you should use the buy, borrow, die strategy. And I'm going to pick them one by one. So, for example, the way this works is, first of all, you buy an appreciating asset.
Assets. That's the first one. It
That's
must be
the
an
first.
appreciating asset.
Yes, it must be an appreciating asset. And when we talk about appreciating asset, it must be to some extent. Let us say, I'm going to use the US as an example. Then I will tailor it to Nigeria.
Yeah.
So in the US, let us say I buy maybe a company, or let me even use the broad market index so that for purpose of, so I don't have to pick names, because at least we know the returns, the average returns of the broad market index, like the S&P 500 over years. Already is up 12%, 12.49% year to date. So now, I buy the S&P 500. Let's say I have, $100,000. I'm just using this. I mean, you can start with even $10,000.
Okay.
$100,000, I buy the S&P 500. Typically, the S&P 500 yields an 11 to 15% per year. I think for the past 30 years, that's the average. Some years could be good. For example, over the past 3 years, this is the fourth bull market.
Yeah.
You know, the first one was in 2023, 2024, 2023, we had 24% return. 2024, we had 23%. 2025, we had 19%. So that is even higher than the average, but I'm looking at the average. Then you buy the S&P 500, for example, with $100,000. It is an appreciating asset. And the way it works is that when a company, the reason why the S&P 500 is so good is it's a market index that a lot of people, even very sophisticated fund managers, still fail to outperform the S&P 500. Because the way it works is, it's the top 500 companies. If your performance does not meet certain criteria, you're removed and another company is added. So they review it every September. This September, they will do another review. So they review it from time to time. So because of that, it allows the index to have some of the best performance you can think of for a broad market index. Yeah. So that is the buy version of the strategy. You buy an appreciating asset. So it's not just the index. You can buy company stocks. You can buy even precious metals. You can buy even Bitcoin, crypto assets. So, but I mean, you will understand why you not just any crypto assets. You are looking at Bitcoin, Ethereum, because these are the most established crypto assets. If you want to use crypto as your appreciating asset. By the way, I always advise diversification. You want to diversify because you will see the reason why diversification is very important when I get down to the borrow strategy.
Okay.
So that is buy strategy. So you buy an appreciating asset. The next is, again, you can also buy real estate, commercial real estate.
Like physical real estate.
Yeah, commercial real estate, like offices.
Yeah.
You can buy it and rent it out.
Okay.
And then, so cash flow there.
No, talk more about that. You can actually buy it and you rent it out.
Yeah, you can buy a commercial property and rent it out. Yes. So when you buy a commercial property and rent it out, remember, that's cash flow coming in. Good. So that leads us to the borrow strategy. Now you have an appreciating asset.
Yeah.
Now you might need liquidity for two things. Number one, to fund your lifestyle. Number two, to invest in other assets. Remember, a lot of Nigerians, I'm speaking specifically to Nigeria, a lot of Nigerian billionaires have their wealth tied up in assets, securities, and all of that. So opportunities could show up. Generational opportunities could show up.
Yeah.
If you don't have liquidity, then you can miss it.
Yeah.
So that's where the borrow part of the strategy comes in.
Okay.
If you have, let's say you have real estate, there's something we call home equity line of credit, HELOC. Home equity line of credit is you approach a financial institution, maybe a bank, and tell them, listen, I have this house. This house is worth 500 million naira. So I need loan. Maybe you have another property. Maybe someone is in distress, wants to sell a house, and you know that this house is very strategic, or maybe it's in a location that will blow out very soon.
Yeah.
Or maybe the house, you believe you can do a few touches in that house, you can actually rent it out at some very decent amount. Then what you do is that you use your house as a collateral, as whether it's commercial real estate, or a private real estate, maybe a private residence. You use it as collateral to obtain a home equity line of credit, use it to finance, to purchase the new asset. Remember, you are purchasing another asset. So that asset, so your total equity now grows. So you bought a house, you had 500 million in the house, the property of the house that you got. You were able to get a facility of 150 million naira. You use it to buy another house or another property, another real estate property. Now, you are now indebted to the tune of 150 million. But guess what? Your combined equity is worth 600 million. Now, you buy it because you borrowed the money, it comes with interest. Now, let us say that the interest, I'm just using something saying, the interest is, remember, you are paying interest on the 500 million, or the 150 million that you got, not on, that's where you are paying the interest. So let's say, even if it's a 20% interest, even if the interest is at 20%, which is it's not likely going to be so though, but let's say it's 20%, that means annually, your liability is, your debt servicing requirement is 30 million naira. We are 30 million naira. That's 20% of 150 million. 30 million naira. But watch this. You are now getting rental income from both properties now.
Yeah.
So there's a very high chance that these properties, if it depends on the place it is located, can service the loan and start paying back. You can service the interest and start paying back the loan.
Okay.
So that is how it typically works. I'm going to tell you some caveats. The property is growing at a certain percent rate. Let's say that the house, if you are getting 20%, then it will be important to ensure that the appreciation of the asset is above that 20%. Let's say 30%. Let's say that the mortgage, your real estate asset grows at 30% per year. Then you now enjoy that arbitrage of 10%. In addition to the fact that you have a cash flow, it's a cash generating asset, meaning that cash flow can be used to service the debt.
Okay.
Do you understand? Good. So that is but that is just for for real estate. The same thing applies to stock. Let's say you have 1 billion in stocks. A bank can say, okay, here is 100 million naira for you to use. They can extend that. That is what we call securities back line of credit. That because you are backing with securities. Now the securities back line of credit allows you to buy more securities. So you can, out of that 100 million that you were able to secure, you can maybe, you see Dangote is about to list. Then let's say all of your assets, all of your money is completely tied up in securities. You need to participate in that Dangote listing. There's no need for you to sell off
your assets
to participate. I know a lot of people will sell off. That's why I've already advised people sit on cash, because there will be a lot of dislocation. We are in August. Just watch what will happen in the lead up to the Dangote refinery. Remember what happened? The 2.5 billion was private placements.
Yes.
Was not for the public, the retail investors. Retail investors, by the time the hype begins to grow, the retail investors will begin to think there's nothing they will do other than to sell their assets and then in order to participate in the Dangote listing.
Yeah.
So, which is for me is a dislocation that I want to take advantage of. Some of the names that you say, you might see very sharp dislocation as retail investors try to liquidate their position to participate in Dangote. So, but in this case, you don't have to sell. So what you basically do is that you get that credit and participate in Dangote.
You get the credit from your asset.
Security backed line of credit. So against the stocks, the securities that you have. When I mean securities, I mean stocks, equities, and all of that. So you get that and then participate in Dangote. So you don't have to sell. You are still holding your position on those companies. Yeah. While still being able to take advantage of this.
And your asset is paying back the loan.
Maybe it's paying back the loan, but the point is, the important thing is, you can use dividend to pay back the loan.
Okay.
But you can always, there's something we call refinancing. I'm going to go to it later. But let's say I take a loan of 10%.
Okay.
Now, that means for that 100 million, I'm going to have to pay at the end of my yearly liability. Interest liability is 10 million. Is it possible? I mean, remember, I have 500 million or I have 1 billion in equities. There's a very high chance that the dividends I'm even getting from the 1 billion can literally service this debt. Or I can possibly refinance it when it's due. So those are some of the things that I will go into later. So, but you can see from here that you are not selling your securities, your equities, to be able to take advantage of an opportunity or to fund your lifestyle. Rather, you are taking a loan, a securities-backed loan, to be able to fund your lifestyle or to buy. I would always say, and that's what I do. If I'm taking out a loan, most times 90% goes into buying other securities. Maybe 10% to fund lifestyle and other things. Because like I've always advised people on this channel, always have an emergency fund so that you don't have to sell. But sometimes, I mean, for you to be able to maintain your lifestyle, you definitely will need some line of credit and all that. And that's what even the billionaires do. So part of it goes back into buying. So you increase your equity. Because when you buy more securities, buy more shares, remember, you are increasing. So out of that 100 million, for example, I use 80 million to buy more securities. My securities exposure now goes up. My equity exposure now goes up to 580 million. And I'm indebted by 100 million with an interest liability of 10 million. So what that means is that I have been able to borrow without, take advantage of an opportunity without selling. Remember, when you sell an asset, you trigger a taxable event.
Yes.
Not just from the brokers. The brokers, most Nigerian brokers, they 1.4% to 2%. That's what you pay just for hitting that sell button.
Yeah.
That's one part of it. In fact, that's the lowest you are paying. You are paying capital gains tax
to the government.
To the government. So, as far as you don't sell, you don't trigger those taxes.
And you don't pay tax with borrowed funds.
You cannot pay tax borrowed fund because there's an obligation to pay back. So you don't pay tax on borrowed funds. So you are literally avoiding a taxable event by not selling your shares, and you are sustaining your liquidity using funds that you are not liable to pay any tax on.
Is this practical in our client?
I will come to that later. I just want to explain the entire thing, the way it works, and I will tell you the way the Nigerian version can be adapted. For Nigeria, now, the next part is the DIE strategy. So the DIE part of it is that is the most important part of the strategy. That is where we talk about the wealth preservation. I'm going to talk about how it works in places like the US, and then we'll come back to see how we can adapt it to Nigeria. Remember, let's use a typical guy like, let's call him Joe. Joe bought an asset from age 25. From age 25, Joe started working, finished the college, and then started working from age 22. He started investing aggressively. By 35 years, he's already sitting on $4 million, for example. But he keeps on investing.
Yeah.
By age 44, he's already sitting on $10 million in assets. But he doesn't sell. What he does is, if he needs cash, he borrows. Now, he keeps on rolling that, keeps on borrowing, keeps on refinancing. And then, by the time he's maybe 80 years old, let's say his assets has rolled all the way to $100 million. Let's say he's indebted to the tune of, let's say, $10 million because he's been borrowing to sustain his lifestyle. Yeah. He's also been borrowing to take advantage of market dislocations. So and by the way, from age 21, Joe had taken out, or age 24, 25, Joe had taken out a life insurance, which is now fully matured. So Joe at 80 dies. When he dies, there is a tax provision in the US tax law that we will call step up in cost basis.
Okay.
Step up in cost basis. What that means is that, remember, let's say, for purpose of people to understand, let's just say that Joe did not add any other investment. Let's say Joe bought, when he was 25, he bought, let's say, Apple stock. Let's say he was able to buy at $100,000 worth of Apple stock at that time. Now, by the time it was 80 years, that stock from $100,000 now becomes $100 million.
Okay.
Remember, what Joe needs to pay in terms of capital gains, what should be captured in terms of capital gains would be $100 million minus $100,000. Because his cost basis was $100,000. But the value of the asset at death is $100 million. So you're looking at $99.9 million in terms of capital gains. All of these things we are just using an example so people understand. Now, the government should tax that $99.9 million. But in the US, there is a code that steps up the cost basis of that asset to the cost at the time of death.
Okay.
So if Joe died when that asset was worth $100 million, the cost basis of that asset just moved from $100,000 to $100 million. Meaning that the capital gains of $99.9 million has disappeared. Yes. That's what we call the step up in basis.
And it can be passed to the
So if the child sells, if the child decides to sell immediately, the child does not pay a single cent in capital gains.
As tax.
There are other things, maybe the guy, in terms of there are other estate taxes and all of that. But when it comes to capital gains, that child is not paying a farthing. So that is what we call, that is the beauty of the DIE part of the buy, borrow, die strategy. Now, there's something I also mentioned. Remember that Joe has been taking on loans. let's say he has taken on loans up to $10 million. That loan will be serviced by what? His life insurance. That's why you see almost literally all billionaires have life insurance. Life insurance will pay back the loan that he has taken. So the children will just be left with the assets. Now, if you look at the Walton family, for example, the Walton family, like literally all of them are multi-billionaires. They're on Forbes list. What they do is that they don't sell. Even the children will not sell. The children may not even come back and refinance the father's debt. So they don't necessarily have to pay down the debt. So they roll it over and then continue to borrow against and leave the asset to appreciate. So that allows compound interest to work at its best. When you sell, you've punctured, you have interrupted compound interest.
Yes.
But as long as you continue to, as long as you allow the assets to continue to appreciate, compound interest is on steroids. That die part of it. The children can also do the same thing that the father did. When they also die, guess what happened? The basis steps up again, and then their children continue to push until, that is why it's called generational wealth preservation strategy. That is exactly how that strategy works. That's why the rich don't sell. Someone told, at the time Elon Musk was worth 1.4 trillion, earlier this, sometime last month, Elon Musk was in debt to the tune of more than $4 billion. He was indebted to the tune of more than $4 billion. Now, what does that tell you? It tells you that $4 billion is what he has borrowed. Someone would say, why wouldn't he sell just a few stock in SpaceX or Tesla and clear this? No, he doesn't. By the way, just so you know, banks love this strategy so much. If two people, let's say Joe and John, approach a bank, John earns $300,000 and approaches a bank for a loan. Joe earns just $50,000, but is sitting on company stock worth about $100 million. The bank will be very, very eager to lend to John and not Joe, because banks love securities or asset-backed loans because the risk is very low. That's why if Joe goes to the bank and say, I want a loan, the bank might offer Joe that loan at 6 to 7% interest.
Yeah.
But if John goes to the same bank, he earns lower, just 50,000, but he goes to the same bank to ask for a loan, he could get a loan as low as 4%. Because of the asset that backs the loan. So banks love this. So one of the ways of unlocking, that's why I tell people, I say, there's something we call in Nigeria specifically, we have what we call salary loans. Go and find out the cost of salary, go and find out the interest rate of salary loans. Very insane. In fact, I know some that are doing 30-40%. They are doing 35 to 40%. But tell someone else, in fact, some I don't even do 50%. As a matter of fact, there's one that told me that 50%. The same financial institution, when they see someone working with 100 or 200 million naira worth of assets, you see the same institution will be negotiating 15 to 16%, because this is an asset-backed loan. So one of the things I say is to be able to get better terms of loans, it's better you go with an asset rather than going there with your I'm earning 5 million naira per year. That doesn't make any sense. But if you say I have a rental, or even 5 million naira per month, but if you say I have a rental property that is actually worth about 200 million, banks will listen to you. So that is the buy, borrow, die strategy in the US. Now in Nigeria, there is a little. Remember, I told you there are 4 pillars for this strategy. The first is buy, of course.
Yes.
Nigeria, but remember, the US is the deepest stock market in the world. Nigeria is still fledgling. Like I've said it over and over again. The debt to the capital market to GDP ratio, the market capitalization to GDP of our markets is 35%. So it's still shallow. But there are some assets that have proven. So the challenge is that we don't have those assets that you could be looking at, a 50-year asset, might be very little, actually. There are some, I told you that there are some, I take loans against my assets, my securities-backed loan, and it is restricted to just the NGX 30, the top 30 names. So if you have assets, if you have stock in other in companies that are not part of the NGX 30, you cannot access this.
Okay.
Because of the shallow nature of the Nigerian market. So if you want to buy, you have to buy one of the top 30, the NGX, one of the companies, the NGX 30.
That's the qualification.
Yes, that's the qualification. Number one. Number two, the borrow part. That is where I have a challenge, a very serious challenge. I'm going to tell you an offer, a way out of this. The interest rate, the MPR is currently 26.5%. So there's no way a bank would offer you a lower interest rate. It's impossible because that is the cost overnight of loan. That is bank to bank, actually. So you are looking at maybe from 30%, most likely 30% interest rate of 30% per annum. Now, when that happens, there is a problem. And the problem is that what asset are you going to buy? Remember, I told you that the yield, the return on the asset has to be higher than the interest you are paying for this strategy to make sense. The challenge is getting a company or a stock or an asset that must grow. If you are taking a loan at, let's say, 30% per annum, then there's a security line of credit at 30% per annum, then you must, if whatever you're investing in must give you at least 40 to 50%.
Okay.
For this to make sense. Remember, apart from even the loan itself, the fees. So let's say the fees come up to about 3%. And then you invest in something that yields 40%. That means you are making an arbitrage, a net of 7%. So you are looking at something that can yield 50% per year. It's a bit challenging to find such assets.
Okay. That
That is why, for me, where I really exercise the buy, borrow, die strategy is in my foreign portfolio.
Okay.
Because when you're in a foreign portfolio, I'm paying 3.8% in interest per annum. And even if I invest in the S&P 500, which I'm not like looking at the S&P 500, I'm looking at I've been moving across names, especially, I know that this decade is the AI decade. So the likes of NVIDIA, I've been really exposed to NVIDIA and some names in the AI infrastructure build-out space. But because I'm getting, and already some of these names have already done over 200%. So that's already a good start. But even if I wanted to invest in the S&P 500 that returns, let's say 13% or even 11%, because I'm getting the loan at 3%, call it 4%, I'm already enjoying an arbitrage of 7%.
Okay.
At 11% return on the S&P 500. So that is the only challenge in implementing this in Nigeria. The cost of borrowing is very high. That's why when you hear people say that the CBN should actually lower it, it's not because they are saying we should make money free. It's because some of these things or these strategies cannot work. Because you need to find a business that will pay you way higher than what you are paying in interest for this buy, borrow, die strategy to work. In fact, in Nigeria, another challenge I have with implementing buy, borrow, die strategy in Nigeria is the part of the die strategy. In Nigeria, we don't have step-up basis.
Okay.
At all. We don't have it. So the only thing is that there's a way you can structure your estate. So you can do proper estate planning to reduce the exposure to taxable assets. Okay. So one of the things which for time I might not really be able to delve into is what we call real estate planning, family planning or estate planning, which is where you, instead of having to buy in your name, you buy in your company's name.
Okay.
or you float a trust. You float a trust because float a trust and then push all your assets to that trust and make your children beneficiaries of that trust. It's a complex strategy though, but I mean that is just the overview. Create a trust. That's why you see almost all billionaires in Nigeria, they have trusts. It's not even only Nigeria, even outside Nigeria, they have trusts. Then they make their children beneficiaries of that trust. So you have reduced your exposure to the taxable part of your wealth. Because they borrowed the type of basis don't all work in Nigeria. So the only part that you can benefit from is reducing estate taxes that you pay.
Okay.
So
that's the only problem we have.
So that's the problem that we have the problem with borrowing because of the high interest rate environment, and we have the challenge that there's no step up basis, which means you can only rely on a cleverly managed estate planning.
No, I'm looking through this question. I think you've actually answered everything. You answered everything. Somebody said, how much do I actually need in stocks before a bank can let me borrow against them at a good interest rate?
It depends.
Okay.
It depends on how the bank itself.
Okay.
So, for example, I know of a platform. That if you have up to 10 million, you can. But 10 million in a Nigerian platform, 10 million, but it has to be among the NGX 30.
Okay.
So if you have 10 million in total equity,
They can give you how much?
they can give you as much as 20%.
Okay.
Much as 20%.
Somebody saying, if I start doing this now and change my mind in 5 years, how hard or expensive is it to exit the strategy and pay off the debt?
You can exit the strategy, but at which time you would have made. But like I told you, you would have stopped compound interest.
You punch your compound interest.
Stop compound interest. But you would have exited. You would have made some money, definitely. Because think about it, if you do it even in 5 years, and then you buy an asset, and then you borrow against the asset. Remember, as far as your borrowing cost is lower than the appreciation in terms of the asset, then you are still enjoy the arbitrage over a 5-year period.
Another one says, if the stock market drops 30% tomorrow, what exactly happens to my loan and my stocks?
Good. So that is where it comes in, what we call margin debt. You have to be very clever. Let me give you an example of what I do. I have exposure to Bitcoin.
Okay.
Yeah. So, and I do the same thing on Bitcoin. So the point is that over the past 13 years, the sharpest correction in Bitcoin has been 80%. So the maximum I can borrow against my Bitcoin holdings is 10%. So I give that 10% buffer. There's something called loan to value ratio. So if you have a loan to value ratio of, let's say, the liquidation point or the margin call, there's something called margin call, there's something called liquidation. So let's say the margin call is, let's say, 80%, and then liquidation is at 95%. That means that if the value of your asset, of the value of your loan is as high, let's say the value of your asset is dropping, so the loan to value ratio now gets as high as 95%. The creditor can sell your assets to repay the loan. Good. So what you do is, for me, I ensure that my loan to value does not go above, at any point in time, does not go above 10%.
Okay.
Or maximum is 15%.
Okay.
So that in the event of a crash, like 30% crash means that at the maximum, it would take it up to 40 or 45%, which does not even trigger margin call.
Okay.
Because once you trigger margin call, if you don't have more assets to add to the pool, then you run a risk of forced liquidation.
So you have to do your own calculation.
So you have to do it. The best is, ask yourself, what in a black swan event, like I did for Bitcoin, I said, black swan event, what would be the highest drawdown in Bitcoin? And a historical records show 80%. So I said, okay, let me give a buffer of 10%. That's why my loan to value is 10%.
Okay. All right. Another one say, how long will I have to fix things if my portfolio value drops too low before the bank starts selling off my stocks?
So that is the reality. That is the reason I talked about That's the reason I talked about diversification. So for this, you don't just do just stock market. I don't only do stock market. So you can do equities, you can do real estate, you can. So because the idea is you can provide more collateral. This is just a market dislocation. It's not as if the market, historically, the market will always go back up. Do you understand? So it's a market dislocation. If you have assets, diversified assets, all the assets will not fall at the same time. That's why we talk about some assets as defensives. When growth assets fall in high interest rate environments, defensive assets remain stable. So you have if you have done your portfolio management strategy properly, then one of the things you notice is that your portfolio will not drop scandalously. Let's say wipe of 50% or 60%. No, that means you have been overly exposed to the growth assets. There's something we call high beta and low beta stocks. A high beta stock, a high beta stock is a stock that amplifies the gains of the market. Let's say the market is 11%. If the market is 11%, that stock would be 33%. If the market shoots up by 11%, that stock will shoot up by 33%. If the market corrects by 10%, that stock will correct by 30%. So you want to look at a proper mix. This is pure portfolio management strategy. You want to look at a proper mix so that you are sure that at a point in time, your portfolio does not dip below a particular point. While you're trying to maximize your Sharpe ratio, you also want to maximize you want to blend a good Sharpe, an excellent Sharpe ratio and portfolio stability. Meaning, while you expose yourself to growth stocks, if you observe the names I call on this channel, I would mention growth stocks,
dividend stocks.
Growth stocks. I will also mention defensive stocks. So it's not, you don't just expose yourself to growth stock, because if anything happens, you can have a very wide swing. I also don't do completely defensive because I will miss out on gains. So you do growth stocks and defensive. And by the way, this is something that for an actively managed portfolio strategy, nothing is written on concrete, nothing is cast in stone. During bull markets, you want to lean more towards the growth stocks and less towards defensive. During bear markets, you want to lean more towards defensive stocks and less towards growth stocks. So that's how you do, so that you ensure that
now, the final question is what happens if interest rates go up while I have an active loan?
Good. So that is the point. That is what we call refinancing. You can refinance the loan. Do you understand? You can actually refinance a loan. The idea is there is something we call fixed rates and floating rates. So for example, I could decide to take out a fixed rate. Fixed rate is usually higher than the floating rate, but fixed rate ensures that you can do your mathematical calculation very well. Let me give you an example. Let's say I take a fixed rate of 10%, and then the CBN jacks up interest rate. If I did it for 2 years, I'm paying 2 years. Even if they jack it up to 30%, I'm paying 10%. Maybe at the time I fixed it, the flexible rate would have been maybe 5%. So I'm paying a premium for a predictable loan tenor now, or interest rate tenor. But if you do a flexible, that means that as the CBN increases interest, then that's how your loan interest rates. So what you want to do is, one of the things that can save you is that if you are not able to take out a fixed interest over a long period of time, then you can do a flexible interest, but ensure that you balance your risk. Balance your risk. That's the most important thing, is a balance of risk, so that even if in a high interest rate environment, you don't receive margin call. Because if you are your exposure, your margin debt is high, your exposure is too high, then as interest rate grows high, then your loan to value begins to do what? Shoot up. It most likely might get to a point where you receive a margin call, or you are forcibly, you experience forced liquidation.
You've done justice to this conversation. But before we go, I want you to speak to Nigerians, those on the NGX platform, that want to participate with this strategy. Maybe not in the Nigerian market, maybe in the foreign market. How would they start?
So very quickly, I told you that the way I do is, I use a foreign platform actually. Now, maybe you've heard, but the Securities and Exchange Commission has approved the first tokenized securities. It's going to come up in September. So that means that you can it's actually designed to actually bring in the younger generation. So what that means is that you can actually use tokenized version of securities, which allows it deepens. It has a way of deepening the market because it allows more people to participate, especially people in the. It's a blockchain innovation. So what I do for me, and maybe you can try if you want to. I have most of the stocks I do, even the US stocks, apart from the likes of Bamboo, I also have a platform called Bybit. So I buy tokenized version of securities. This tokenized version of securities allow me to have exposure to very low interest rates. That's why I told you I'm paying 3.8%. If I tell someone in Nigeria that is paying 30%, the person will be like,
3.8% where?
I'm telling you, I'm paying 3.8%. So you could get 3.8%. You could get very low loan. And that for like Bybit, you don't need to get. For example, in Nigeria, you must have at least. I think Bamboo does. You must have 10 million in stocks, worth of the NGX 30 stocks.
Yes.
Before you can get a line. This one, even with $1,000, you can still get a loan. Even with $500, you can still get a loan. But like I told you, you have to manage your LTV, your loan to value ratio. So you can get a loan and then even take advantage of other opportunities. The problem, what I would say to Nigerians is, I don't advise you to do this strategy using a Nigerian denominated loan
assets,
because the interest rate is too high.
Yeah.
You might be gaining exposure to 30% in interest rates. The challenge would be for you to find the asset that will yield above 30%.
Yeah.
Way above 30% for that strategy to work. So, I mean, that's why we on this platform, we tell you, you can research other platforms. You don't even need to do Bybit. You can research other platforms that allow you to, where you can buy and hold assets, appreciating assets, but gives you exposure to interest or loans at very, very low interest rates.
Okay. All right. Thank you very much. I think we've done a lot for it. And further conversation, further comments will actually communicate in other videos. Thank you very much for coming.
You're welcome.
You've done well. Thank you very much.
On that note, we'll come to the end of today's episode of Clockwise. Now, please do not forget that everything we do here is strictly for educational purposes. If you want to invest, you have to do your research yourself, or you speak with your investment advisor to show you what to do. Everything here is strictly for educational purpose. Now, my name is Providence, and thank you for actually staying to this point. And also, if you want to be part of our community, our Telegram community, we have a link on our profile page. Our profile page is a page that has our logo. So you go there, you see a Telegram link that can take you straight to our Telegram community, where we discuss in-depth conversation about the stock market on real time, and we respond to questions on real time. You can go there and we'll see you there. Thank you for staying, and I'll see you again.